Can property values really keep rising despite high interest rates and relatively lower wages growth? Well, my guest today, Stuart Wemyss, believes they can. So today we'll be diving deeper into this topic, exploring the dynamics of income, borrowing capacity, migration, inheritances, and a lot more, and how all these interplay to shape the property markets. So whether you're an investor looking for insights to guide your decisions or simply curious about the forces shaping the Australian property market, this is an episode you won't want to miss. And at the end of today's show, I'm sure you're going to have a bit more clarity about what's ahead. So let's dive in.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
What on earth will make property values keep rising in the current high inflationary and low wages growth environment? I'm sure you've heard many commentators refer to the price of property relative to household incomes, and they suggest the cost of dwellings currently are much too high for current income levels. So what could make property values at the current rate of income growth keep rising? Well, that's what I'm pleased to have a chat about with my regular guest, Stuart Wemyss, Director of Prosolution Private Clients and a seasoned financial advisor, because he recently wrote about this topic. He's got a wealth of experience in the Australian property markets. Stuart, welcome for today's show.
Thanks, Michael. Is seasoned financial advisor and just another way of calling me old?
Well, I've got the grey hair and you haven't yet. But I guess you've been an observer and an analyst of the market trends, and you've written about them for a long time. But interestingly, I also enjoy your weekly blogs and podcasts because they are thought-provoking and you sometimes challenge some current beliefs. And one of them was recently in your Investopoly podcast, where you start with the premise that many commentators who are offering advice at the moment are going to get it wrong, that house prices in Melbourne and Sydney aren't too high for median incomes. Why do you say that?
The first starting point is let's test the thesis that property should be a function of income. And so the thesis, of course, is that if my income increases, so does my capacity to be able to afford a higher value property. And therefore, as long as my income increases perpetually, then perpetually property prices can move forward. Or turning that around differently, the argument would be, is anyone ever going to be able to afford property if prices keep rising but incomes don't? It's an interesting question. It makes sense, right? It makes logical sense that, of course, it should be linked to incomes.
There's nothing new about this, Stuart. I remember in the late 80s, I'm older than you, that it was in the news the same as now. Our kids will never be able to afford property because look how expensive properties are relative to income. And that was 40 years ago.
Yeah, that's right. So I guess maybe we can point to that history to say maybe property prices aren't linked to income. Maybe something else is going on that's contributing towards property prices and affordability. The other point I would make is that for all those years, we've been talking about, whether property is affordable and will it continue to be affordable. Meanwhile, there's plenty of people going out and buying property and paying more than they did 10 years ago and 20 years ago and 30 years ago. So clearly it's affordable to some. And I would agree that maybe the proportion of Australians is shrinking that can own property. I appreciate it is more expensive to buy today than what it was 10 years, 20 years ago and so forth. But there is enough people out there that have continued to push prices higher over the last 40 years. So I thought it was really interesting to look a little bit deeper, a little bit closer at that, to try and work out, what's going on, what is driving that growth.
Well, you're right that the percentage of Australians who own their own home has decreased, but I think there's a number of reasons for that, not just affordability, and maybe we can have a chat about that in a moment. But the other thing is that over the last decade, there have been 1 million new first homeowners. The government's included various grants, as we know, over COVID and other times, but people are still getting onto the property ladder, aren't they?
They are. And, it doesn't come without sacrifice, of course, and that's probably, one of the points that we've tried to make over the journey is that, if you're focused on building wealth, or if you're focused on getting into the property market, maybe there's going to be some sacrifices that you need to make. You can't necessarily have the fantastic holiday and buy property in the same year, for example. You're going to have to make some choices there. But for people, in fact, I think we did an episode on it, Michael, for younger people, the access to information, borrowing capacity, borrowing power, there's a lot of advantages that first home buyers have today that just weren't present even 10, let alone 20 years ago. And you look at the data, you look at the evidence, clearly people, 1 million new first home buyers in the last decade, clearly it's working for some people. And for those that are sitting on the sidelines, perhaps instead of complaining about it, and I'm not saying everyone's complaining about it, but instead of focusing on the articles that complain about it, why don't you find out what other people have done to get into the property market and just repeat what they've done.
Okay, getting back to the original premise that they used to say in the old days, median house price in Sydney and Melbourne was 3 times, 4 times the average income, and now it's 10 times. But it's a bit like saying higher interest rates are going to make the property market crash. And because it actually costs more to own a home because the mortgage costs more. So even if you're not earning more, and it's something a bit to do like income, isn't it? The cost of owning a property. Having said that, there are multiple factors driving property markets. But let's talk a bit about borrowing capacity. How does that affect price growth?
Borrowing capacity, I think, has affected or at least contributed to price growth over the last 2 to 3 decades. To what extent? It's impossible. That's the difficult thing. It's impossible to pull these things apart. People's borrowing capacities in terms of how much they can borrow and really 6 to 7 to maybe 8 times income, gross annual income, is what someone's borrowing capacity is today. Going back 30 years ago, it might have been half to a third of that amount. Our purchasing power has increased. Even if our income hasn't increased, our purchasing power has increased because banks will lend us more money than what they would have done 30 years ago. And we can see that in household debt numbers, that they have increased substantially. Now, a lot has happened over that period of time. You've had banking deregulation, the internet, in terms of providing access to information and comparison of borrowing capacity, interest rates, and those sorts of things. So there's a lot of things that have happened there other than credit policy that's probably contributed to that. But certainly that is stimulating. And I know, you can find a distinct relationship between money supply going into the property market and price growth. So we know that when loan volumes are high, the amount of new lending that's going into the market, we know that either at the same time or it will eventually occur, that'll stimulate price growth. So certainly borrowing capacity has made that contribution over the last 2 to 3 decades. To what extent it's difficult, I would say it's probably a material contribution.
Now, just to interrupt, sorry, that's because interest rates have significantly fallen over the last couple of decades until recently. Is that why borrowing capacity increased so much?
Well, changing credit policy and the way that banks manage loans, introduction of alternative lenders that have created greater competition. So Aussie Home Loans, it's now owned by CBA, but, it sort of shook up the market. So all those mortgage managers that were around in the 90s and 2000s really created that or stimulated that competition. And they were lending borrowers more than what the banks were. Banks were being ultra conservative. And so they've sort of come to market to sort of play. And obviously interest rates have been lower on average over the last 20 years than the previous 20 years as well. And that certainly helps. But it's really around the credit policy, I think, that's really, really helped extend someone's borrowing capacity.
What about moving forward? What do you think is going to happen to borrowing capacity over the next years and even decade if you're prepared to look out that far?
And I think it's a really important consideration because if we say that borrowing capacity has contributed to property price growth, if we agree that it has over the last 2 to 3 decades, we need to form a view of what's going to happen over the coming decades. I just can't see borrowing capacity really changing materially. I think there'll be some tinkering at the edges to either increase it or slightly decrease it. But I don't think we're certainly not going to see the dramatic increase in borrowing capacity that we have seen over the last 2 or 3 decades. That's not going to repeat itself. And the point to make then is that in a rising tide, all ships rise. So when all Australians' borrowing capacity has increased over the last 2 decades, that's been a massive stimulus into the property market. And we know that really, we talk about asset selection, how critical it is for investors, and it is. But the reality is, if I had bought a property in the 80s in Melbourne, Sydney or Brisbane, I'm probably sitting on a heap of equity today, even if I made a really terrible mistake. Now, it's all relative, so I could have been much better off if I didn't make the mistake. But the point is that it has been a rising tide. Well, if we can't rely on borrowing, or we assume that borrowing capacity is not going to change for all Australians over the next, like it has previously, then we're going to have to be more selective. Then the answer probably is that not all properties will benefit from the same rising tide.
So you're suggesting areas where people have got higher incomes, that means they can borrow more, or have lower mortgages, like the more established areas, are more likely to outperform?
I think it's true that incomes drive purchasing power or contribute, one contributor towards purchasing power. I think it's true that there's some demographics and cohorts that are solely reliant on income to drive purchasing power. And I also think it's true that wages, there's no signs at this stage that wages are going to grow by more than, say, 5% per annum over a very long period of time. I think wages growth will be relatively benign compared to what historic property growth has been.
And that's actually, if that does grow at 5%, it's above the average over the last years. And I guess with all the people coming into Australia, if we are going to have more people available for the jobs, that's also going to hinder wages growth.
Yeah, not more than 5%. I think I'm not sure it will get to 5%, certainly not exceed it. I guess the other thing to think about then, Michael, is yes, borrowing capacity has increased, incomes have increased a little bit. Well, what else is contributing towards someone's purchasing power? And I think if we focus on that question, then I think that helps us answer where should we be investing in terms of what type of property, what locality, what demographic am I targeting in terms of that property going to enjoy demand from? And that was really the thesis of my most recent blog, was really around, those factors and trying to unpack those factors. Because clearly, even though if you look at a macro level, wage growth is relatively benign, relatively low at the moment. Clearly, for some people, that they can afford to pay more. For some people, they can afford to invest in property. They can afford to upgrade. So who are those people? How is that happening? And how can I, as an investor, ride on the coattails of that demand?
Okay, you've obviously looked at it, and what's the answer?
No, I don't know what the answer is. It's very difficult to really pull this stuff apart. And that's why, and we've done an episode previously about it, Michael, we've spoken about a lot, in fact. That's why property, I think, is part art, part science, is that we can get very scientific about property, we can get buried in the data and so forth. Doesn't always reveal the true story to us. In fact, data can lie sometimes, which I'm not saying you can manipulate data, but you can misread data. Whereas you need to have equal parts science and art. And the art part is really understanding, I guess, the psychology of property decisions and the people that make them, and really understanding how investors behave in the market. And I think that part is actually missing from a lot of commentary in Australia, particularly from economists. And that missing part is really difficult. So when I've sat back and thought, well, what else other than incomes is contributing towards property growth and could contribute towards property growth in the future, it was really about reflecting over the last sort of 20 plus years of talking to clients and observing lots of different property decisions that have been made in the market. And so what I did is I sort of identified 5-ish factors that I know in my client's situation, even my personal situation, these things have actually contributed to someone's ability to either upgrade their home or invest in the property market or make improvements to their home. And in fact, before we get into them, that's the thing to point out as well. When people look at sort of median house data or what are the price of properties done in a suburb over a 10-year period and so forth, people need to understand that there's 2 things that would have contributed to those results. The first one, of course, is an appreciation of the underlying land value. Property has got more expensive in that particular location. But there's also some manufactured growth in there as well. There's improvements on the land. And we tend to see that when an area gentrifies as well. People have these older, smaller style houses. They might end up bulldozing them and build some big mansions. And all of a sudden, instead of a family home selling for $1.5 million, they're selling for $3 million, and everyone thinks there's lots of price growth. But really, it's the capital value of the amount that I've spent on the building value that's contributed to that. So I think and it doesn't really matter which has contributed, but that's where the growth is coming from. Because if I have a home and then I win Tats Lotto and I decide to bulldoze my house and build something for $3 million, for example, it still is important to understand where that contribution has come from. Of course, Tats Lotto is a silly example, but so the first one I thought about or identified was investment returns. And really that has a contribution because obviously that adds to our overall financial position, the strength of our financial position. And so I guess, when you look at residential property as an asset class, it's 3 or 4 times bigger than the share market in terms of value, total value of Australian property. So of course it's a massive asset class. I don't think we should be too surprised that if we see investment returns in the share market have been about 10% over the last 40 years, and returns across property, both rental income and growth, have also been around about 10% over the last 40 years. I guess we shouldn't be surprised by that. And super returns are very similar to those numbers as well, about 9% over multi-decade periods. And so there's that wealth effect that's going to contribute towards someone's capacity to be able to invest in or upgrade their home. Invest in property or upgrade their home as a result of the fact that some of their wealth is invested in other asset classes that have been returning to 10%. And so we should probably expect a bit of a bleed over from those returns that have helped sort of fund property prices as well.
Sure. What about migration?
Yeah, migration's a big one. I was interested to read a report recently, Michael, that said 125,000 millionaires are expected to migrate to Australia in 2023.
In this year alone?
In this year alone. So it shouldn't surprise us that, Australia is a lovely place to live. I know we both travel around the world quite regularly, Michael, and I'm always interested to kind of reflect on standards of living and pros and cons of different cultures and locations and so forth. And Australia, we can sit here and make some complaints about some things, but in terms of balance, the balancing out the pros and cons, Australia does have a really good balance. And, if you've got a bit of money, I can understand why it's an attractive place to come to. So, of course, if someone immigrates, they're probably the first thing they're going to do is go and buy a family home. And then if they're a wealthy individual, I imagine at some point, some of that money finds its way into investment properties as well.
Sure. So we're talking about the various factors other than wages growth or credit that's pushed up property values. So you talked about other investment returns, migration. I see that there's also a significant transfer of wealth. It's probably not going to happen as much for another decade or so until the baby boomers eventually die out. But the bank of mum and dad's already helping people. We're not necessarily needing to wait for the parents to fall off the perch before passing on the money.
Yeah, the rich get richer and the poor get poorer, unfortunately. The wealth inequality has been a growing problem really over the last 100 years, particularly in the US and also in Australia to a larger extent as well. And inheritance just, I think, contributes to that wealth inequality because wealth gets passed down between sort of family members and so forth. So the Productivity Commission actually released a report that predicted that $3.5 trillion would be inherited over the next decade. And in fact, by 2050, the annual amount of inheritance is estimated to be $224 billion. So there is
every year.
Every year. So there's a inheritance tsunami coming our way. And then we've just got to think about, well, who is going to enjoy those inheritances? And where are those people living and where do they want to live? Where are those parents that are going to pass away and leave that money to kids? Where are their properties? I think we start thinking about some of those contribution factors. It tends to educate us into, what areas might outperform, from an average growth perspective.
Well, if you think about it, a lot of baby boomers have minimal mortgage or no mortgage against their home, and when they eventually die over the next decade or so, they're going to be passing that on to their children and grandchildren, who probably already are going to be quite established in their 50s and have their own home. So when this wealth gets transferred, I guess a lot of it's going to be reinvested into property, but maybe more in property investment. Some will upgrade their homes and some will pass it on to the grandkids. I guess if people are concerned about should I hang on to property or not, if we thought we had a good time now, wait till the 2030s when the last of the baby boomers pass away.
Yeah, that's right. And I mean, I was just talking to a client over the last week. Unfortunately, his mother has passed, and there's a property that they're selling, and there's 3 siblings. 2 of the siblings are going to complete some substantial renovations to their existing property. The other sibling doesn't have a property yet, so they will buy their first property. Essentially, that whole inheritance is going back into the property market, but maybe not geographically the same types of property, which I think we'll get to in a second, but that's something to consider. The next thing was business exits, Michael. You know, people that have been fortunate enough to sell part or some of their business. This is for self-employed people. I know from experience, you know, if there's a large sort of cash injection that someone enjoys from selling a business, they'll either upgrade their home, they'll go and buy a second home, so a beach house or something, or they'll invest in property, or they'll do all 3 of those things. But some of that money will end up in the property market almost always in that sort of situation. And the last contributor, which I think is probably more common over the last 10 years than previously, was at-risk income. So that's for people that are PAYG, they're employees. They'll have a base level of remuneration, of course, and then there'll be some other components, short-term incentives, which could be stock that's given to them if they work for a listed entity. It could be bonuses, you know, these sorts of things. So I'm finding that they're more common, and the quantum of the income that they're enjoying is quite considerable as well. And that will certainly add into their purchasing power. The other thing too is, you know, there's certain cohorts and demographics that will enjoy, you know, rising income much faster than the average. And people I'm talking about are really, you know, the people that are really career orientated, that are focused on promotion and so forth. And, you know, I might have a client, their income might be 150 today, and in 10 years' time, they could be earning north of $500,000. Their income is increasing at a much faster rate than the average. Well, it's important for us to think about where do they want to invest, where do they want to live, you know, where is that money going to go? So there's about sort of 5 factors there, Michael. We talked about investment returns, immigration, inheritances, business exits, and then additional income like bonuses and shares and so forth. Those financial resources make a material contribution for some demographics into increasing their housing affordability and the amount of money they have to invest in property, as well as income. Of course, most of those people still earn an income as well that may or may not be rising. So I think focusing on income alone, again, depending on the demographic and the location of the property, but focusing on income alone doesn't always tell the full story.
Okay, having said that, do locations where people have higher incomes perform better than other areas?
Well, there's a data analyst, Jeremy Shepherd. He looked at that and he found a very weak relationship between incomes and capital growth. And I think this is another example of how property is part art, part science. Part of the reason, which Jeremy acknowledged himself, for there being a weak relationship is the data is very difficult and can be out of date. You know, they're using sort of census data and, you know, is it completely reliable? But he certainly looked at that. Now, of course, you would think that, you know, if I invested in locations where people had higher than average incomes, the property price growth should be better in those locations. And anecdotally, I think that's true, although it's not representative in the data. But we don't really need to look at census data to try and identify areas where there are more wealthy people live. You know, the average wealth is higher. You know, I think most people will know those suburbs, particularly in the states or locations or cities that they live in. You know, we don't really need to divert to a spreadsheet to work out those locations.
Well, I think looking even deeper, finding areas where the wealth is changing, gentrifying locations is going to be a great way of finding properties that outperform, because gentrification doesn't occur over a week or two or a year or two, but often over a number of decades. And as wealthier people move in, millennials are moving into certain areas now as they're getting to household formation age. I think that's a good trend to look for.
Yeah, definitely. And I think, when we sort of sum up the thought process around this, you really need to invest in locations that are going to benefit from financial resources in addition to income. So we know we've spoken about, borrowing capacity. Well, borrowing capacity is probably not going to make a contribution to property price growth in the future. Incomes could, particularly if, the property buyers have higher than average incomes and they enjoy higher than average increases. But really what we need to do is invest in properties and locations and type of assets that are going to be attractive to that cohort that will have all those other financial resources that contribute to their capacity to be able to pay more for property. And I guess the idea is, or the conclusion is, that I think property investors need to be more careful about the types of assets that they invest in than what they might have had to do, 30 years ago, because as I said, 30 years ago, it was a rising tide and all ships rose.
Yep. So before we finish off, you mentioned a couple of times about your clients and about what you do. I know what you do, and regular listeners probably do as well. But I know we've got many new listeners every episode. So tell us a little bit about what Prosolution clients do and how you can help them.
Michael, we like to inspire our clients to take a holistic approach towards building wealth. And, we know many financial decisions are multifaceted that include, considerations around borrowing capacity or taxation and financial planning and cash flow and so forth. And so by taking a holistic view and making sure we look after all those aspects for clients, we ensure that we maximize their opportunities and minimize any risks wherever possible. So our goal is to build a long-term relationship with clients, help them achieve their lifestyle goals by providing that holistic advice.
Well, I think it all starts by putting a plan together. I know we both feel similarly for our clients. We in the property area, you in the wealth area, because as you said, you can't just go out and buy a property and hope it's going to outperform. Many times you've talked about making sure you buy the best quality asset. At the moment, when the market's clearly turned, it's bottomed out earlier this year, and all the data houses have agreed that we've now moved to the next phase of the cycle. I can't see a boom happening anytime soon, even though property prices are rising. So careful property selection is important. Maybe we can finish off with one of your favourite themes about the quality of the property is more important than getting it at a good price.
Well, I think that's true. And I think I would not be surprised if come next year, 2024, everyone will be keen to invest in property. Now, I know that's a silly comment, everyone, of course not everyone, but most investors.
Because the media will tell them it's the right time.
Yeah, and then they'll start seeing the market move and the conversation will change from, what is the future growth? And then you'll get the banks that'll come out and say, hey, we think property is going to rise 10% this year. And all of a sudden, you've got to go and compete with a whole bunch of different people, which is fine, of course, because sometimes that's what you have to do in a market. We did an episode in the last 6 months, Michael, that said kind of now's the best time to buy property because there's not a lot of competition. And so you do yourself a favour by operating a market where there is less competition. But of course, having a plan is incredibly important because what you really want to do is work out how much do you need to invest to achieve your lifestyle goals and what's the least amount of risk that you can take, that you should take in order to achieve those goals. And so instead of going and saying, oh, I want to go and buy 4 properties and at 700,000 or 500,000, whatever it might be, in fact, once you do the numbers and sit down and get the advice, you might actually be better off just buying one property for $1 million or $1.5 million. And sure, you put all your eggs in one basket, but what you're actually doing is reducing your investment risk. Because if I invest in the highest quality asset, let's just say I invest in the highest quality asset Australia has to offer, this magically golden A grade property. Well, what's the chances in 20 years that that's going to be worth 4 or 5 times what it is today? The probability is almost certain because I've invested in the best quality asset. So the analogy I like to use, Michael, is instead of buying the diamond, buy the pink diamond. because pink diamonds are always going to be in high demand. Diamonds are always going to be in high demand probably, but pink diamonds even more so. And so even if you have that concentration risk that you're going to put all your eggs in one basket, as long as that basket is such high quality, it'll actually ultimately reduce your risk over time. And so I think quality is critical with all investments, particularly property. And I think quality will be far more important over the next 2 or 3 decades than it was over the past 2 or 3 decades.
I agree with that. And that once-off bargain that you may get because you buy something that doesn't tick all the boxes, that's a once-off profit, but it's not going to make up for the regular compounding benefit of owning a quality property.
Yeah, 100%. And I've looked at that in terms of done the analysis. What happens if we overpay 10%, underpay 10%? It's neither here nor there. It's the future growth of that asset. So even if we overpay for a great asset, as long as we're not paying 50% more or something stupid like that, of course, but even if we slightly overpay for a really good quality asset, that'll mean nothing in 20 years' time because the growth will more than offset whatever we've overpaid very quickly. And it's really ultimately, what is the average growth rate of that asset going to be over the next 20 years? You want that number to be the highest as possible. And if it is, it'll easily make up for any tiny little mistakes you might have made at the beginning. It's really about the asset, not the price.
Fantastic. Well, thanks, Stuart. I'm going to leave a link to your blog that we discussed in the show notes, as well as to your Investopoly podcast. So anyone who enjoys listening to Stuart, wherever you're listening to this podcast, have a listen to his on the same podcast app, and we'll catch up again real soon. Thanks for your time, mate.
Thanks, Michael. Cheers.
I hope you got some benefit from my chat with Stuart, and if you did, I'd like you to do me a favour. In fact, I'd like you to do yourself a favour. If you don't already subscribe to this podcast, why don't you click on the link right now before I discuss my mindset message and follow it or subscribe depending upon which podcast app you're listening to. And that way you'll be able to get our information twice a week. Now, in a moment, I will be sharing my mindset message with you. And while Stuart and I talked about the future, I just want to remind you that currently there is more than sufficient evidence that from all the property research houses that we've passed the bottom of this housing market. And as Stuart said in our chat just a couple of moments ago, next year everyone's going to think, hey, I should have got in way back in 2023. You see, an opportunity like this to get in at the beginning of a new property cycle doesn't happen very often. Now, even though I don't advocate trying to time the market, the fact is that most investors would like to take advantage of this stage of the cycle. So how long are you prepared to wait? Why not contact my team at Metropol and have an obligation-free clarity consultation with one of our property strategists to discuss your goals and your options. Go to metropol.com.au and find out about how we can help you. Now, remember, we don't sell any properties, but we offer strategic advice and give you direction, results and certainty. And sure, you can use our buyer's agency or our property management, renovations, wealth advisory, financial planning divisions. We've got a whole lot of ways of helping you plan to become the people you plan to become. Metropol.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today I'd like to share with you a daily tool that the rich use that never occurs to most people. Over the years, I've worked with and mentored many successful investors and business people, and I've found that they use this daily tool that most people never think of. Now, we've all heard about, or maybe used, to-do lists. The best to-do lists incorporate daily activities that help you move towards your goals. You've got them set out there. But to-do lists alone won't make you successful. While it's important to get things done, it's equally important to avoid things that actually stop you getting towards your goals. So you've probably never heard of a to-don't list before, but that's what you need. Now, I discovered this little-known secret of most successful people many years ago, and a to-don't list includes things you should never do because they're either time wasters, bad habits, or things that hold you back from being happy and successful with life. Now, my good friend Tom Corley has written a lot about this in his books and combined a bit of it in our joint book, Rich Habits, Poor Habits. But he also says that to-don't lists are just as important as to-do lists. And he's made a list of things that you should have on your to-don't list. He says most successful people fostered accomplishment in their lives by diligently doing certain things every day and diligently avoiding certain things. He went on to say most people, unfortunately, aren't successful in life. They eke out a living and struggle to just get by, unaware that they're engaging in destructive activities on a daily basis. That makes their own success impossible. So Tom Corley went on to say they're engaging in these activities that might appear on a typical to-don't list of a successful person. And that would say, don't watch more than an hour of TV today. The to-don't list would say, don't waste time on Twitter, Facebook, Instagram, YouTube. The to-don't list would say, don't envy anyone today. Don't make any impulse purchases today. Don't gossip. Don't gamble. Don't drink in excess today. Don't lose your temper. Don't ignore your family. The to-don't list would include things, according to Tom Corley, such as don't read negative news articles, don't procrastinate, don't ridicule anyone, don't hate anyone, don't smoke a cigarette today, and don't be negative. Now, for those who've got a lot of bad habits, to-don't lists are actually more important to them than to-do lists. And you know, in our book, Rich Habits, Poor Habits, which you can get at richhabitspoorhabits.com, we explained that people are going around with one foot on the accelerator and one on the brake. They've got a lot of rich habits, but they've also got poor habits that they've got to get rid of. They've got to break. And that's where a to-don't list will help you. To-don't lists help keep you aware of things you shouldn't be doing. Knowing what not to do, in my mind, is just as important in achieving success as knowing what to do. So, what would be on your to-don't list? When you ask yourself that question, only then will you become aware of the daily habits that are constantly pulling you backwards. To-dos, while a great tool to help you improve your chances of success, are only going to get you halfway there. To-don'ts will get you the rest of the way to your success. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?